When lenders evaluate a credit profile, they are not only examining behavior, they are evaluating structure. Behavior explains how someone acts within their accounts. Structure explains how those accounts are positioned across time. One of the foundational structural components within that positioning is account age architecture. Age is frequently reduced to a simple number: average age of accounts, length of credit history, oldest account on file. But underwriting systems do not treat age as a single figure. They evaluate distribution. They examine how accounts are layered across years. They measure how depth is built. They observe how recent activity is concentrated. Account age architecture includes several dimensions: the age of the oldest active account, the age of the newest account, the average age across the file, the spacing between account openings, the concentration of accounts within specific time periods. Each variable contributes differently. An older account anchors historical continuity. A newer account reflects recent structural movement. Average age blends the distribution into a single summary. But underwriting systems look beyond the summary. They interpret the pattern behind it. Together, these elements form structural depth. Depth signals continuity. Continuity signals durability. A profile that has evolved gradually over a decade presents differently than one constructed within a year, even if both profiles produce similar scores. Consider two files with identical averages. One has a 15-year-old account and several newer additions. The other has only mid-range accounts between 3 and 5 years old. The average may appear similar. The structure is not. Historical anchors reduce uncertainty. Mid-range clustering increases interpretive variability. Structural positioning, Layer 2, exists to evaluate this architecture. Layer 1 measures behavioral repetition. Layer 2 measures structural composition. It asks a foundational question: how is the file built? Longevity provides historical data. Limited duration provides limited observation. Underwriting systems rely on historical density. The longer an account has existed, the more behavioral cycles it has passed through. More cycles provide more evidence of stability. Limited cycles provide limited evidence. Evidence reduces uncertainty. Uncertainty influences probability modeling. Age distribution also influences interpretive confidence. A file with deep historical anchors provides a longer window for pattern analysis. A file concentrated in recent years provides a shorter interpretive window. Short windows increase statistical sensitivity to recent events. Long windows smooth volatility across time. Account age architecture also includes spacing. Accounts opened gradually over time create layered structure. Accounts opened in clusters create concentration. Clustering does not automatically indicate instability, but it shifts structural balance toward recent history. When multiple accounts are opened within compressed windows, average age declines. Recent concentration increases. Interpretation changes, not because of emotion, because of statistical positioning. Age distribution also interacts with account type. Revolving accounts remain open-ended. They age continuously as long as they remain active. Installment accounts follow defined schedules. They eventually close. An older installment loan nearing completion contributes differently than a recently opened credit card. A long-standing revolving account contributes persistent historical depth. Structural durability depends on distribution across types as well as time. Structure evolves. Closing an older account removes historical layering. Opening a new account compresses average age. Opening several accounts in succession compresses it further. Every structural adjustment alters architecture. The score may move numerically, but the underwriting model evaluates structural durability beyond the numeric shift. Durability is statistical. Longer histories provide more observation windows. More observation reduces volatility. Reduced volatility increases interpretive confidence. A profile assembled over time suggests sustained continuity. A recently assembled profile suggests limited longitudinal depth. Neither is inherently favorable or unfavorable, but they are structurally distinct. Layer 2 exists to explain that distinction. Structural positioning measures depth, distribution, spacing, composition, continuity. It evaluates the architectural foundation of the file. Behavior builds reputation. Age builds foundation. Foundation influences perceived stability. Timing shapes movement. Risk interpretation synthesizes them. Account age architecture forms the historical backbone of a credit profile. It determines how much longitudinal data exists. It influences how confidently underwriting systems can interpret patterns. This is not about strategy. It is not about acceleration. It is about structural literacy. The score summarizes numeric impact. The model evaluates structural composition. Structure precedes interpretation. Layer 2 continues next with structural depth and account composition.